In 2021, investors bought one in every 7 homes sold in America. Not mom and pop landlords, not local house flippers, hedge funds, private equity firms, corporations with billions of dollars in capital, and a strategy that most homebuyers never saw coming. They didn't just buy one house, they bought neighborhoods, entire zip codes. In South Fulton County, zip code 30349, nearly 60% of all home purchases in 2021 went to institutional investors, not families, corporations. Home prices in those areas rose 20% faster than everywhere else. First-time buyer purchases dropped, rents surged, and most people had no idea who owned the house next door, because the deed says something like 7842 Maple Trust LLC. This is the Wall Street playbook, and this is how it works. The story starts in 2008. When the housing market collapsed, banks were sitting on hundreds of thousands of distressed properties. Foreclosures flooded every major metro, and private equity firms saw something most people missed: an opportunity to buy single-family homes at massive scale for the first time in American history. Before 2010, institutional landlords didn't exist in single-family housing. The market was too fragmented, too local, too labor-intensive to manage at scale. But the crash changed everything. Blackstone Group spent $10 billion in 3 years acquiring over 80,000 homes. They called the company Invitation Homes. Their motto was simple: buy distressed properties, all cash, renovate them on a budget, rent them at market rates, and bundle the rental income into mortgage-backed securities, the same financial instrument that caused the crash in the first place. And they weren't alone. Colony Starwood Homes took it a step further, issuing bonds backed not by mortgages, but by lease agreements. Tenant rent checks, securitized and sold to Wall Street investors. The same Wall Street that foreclosed on those homes a decade earlier was now collecting rent from the families who lost them. Other firms followed immediately: American Residential Properties, Progress Residential, First Key Homes. They poured billions into markets across the Sun Belt, the Southeast, and the Southwest. In 2017, Invitation Homes went public on the New York Stock Exchange. It was the largest real estate IPO in American history at the time. Blackstone had turned the worst financial disaster for American families since the Great Depression into a multi-billion-dollar publicly traded company, eventually worth more than $20 billion. Single-family rentals were no longer a side business. They were a new asset class. In 2021 alone, 1 year, institutional investors purchased 90,000 single-family homes in the United States. That's 90,000 homes that didn't go to first-time buyers, growing families, or small local landlords. In Atlanta, one of the most aggressively targeted markets in the country, institutional investors bought 1 in every 4 homes sold in certain zip codes. 1 in 4. Not a statistical blip, a structural takeover. The target profile was deliberate. These firms didn't go after luxury homes or starter condos. They went after workforce housing, 2 and 3 bedroom single-family homes in the $150,000 to $350,000 range. That is the exact price range where first-time buyers compete. It's the most price-sensitive segment of the housing market, and institutional cash buyers entered it at a scale that individual buyers simply cannot match. Their offer was impossible to compete with. All cash, no inspection contingency, 7-day close. As a seller, that beats a first-time buyer with FHA financing and a 45-day close every time, even if the price is slightly lower. Today, the 10 largest institutional landlords in the United States own more than 550,000 single-family homes, and that number grows every single quarter. These corporations don't buy homes under their real names. They use shell companies, hundreds of them. Invitation Homes alone operates through more than 200 limited liability companies. Names like SFH Portfolio Trust 7 or Southeast Residential Holdings 12 LLC. Names specifically designed to reveal nothing. Each LLC is registered in a different state. Ownership is stacked layers deep. If you search the deed on a house in your neighborhood, you might find a name like Peachtree Portfolio Holdings 8 LLC, with no way of knowing it traces back to a $25 billion investment firm. This is completely legal, but it is completely deliberate. It allows institutional buyers to operate without public disclosure. It hides ownership concentration from local governments, researchers, competing buyers, and tenants, and it prevents communities from understanding what's happening until the buying is already done. A 2022 investigation by the Atlanta Journal-Constitution found that in some Fulton County zip codes, the 5 largest institutional landlords own more than 20% of all single-family rental homes. 1 in 5 houses in an entire zip code owned by a handful of corporations, operated by call centers, managed by pricing algorithms that adjust rent weekly. That's not a landlord. That's a real estate operating system. The impact is measurable, and it falls hardest on people who had the least leverage to begin with. A 2022 study by the Federal Reserve Bank of Atlanta found that in neighborhoods with heavy institutional buying, home prices rose 12 to 20% faster than comparable neighborhoods without institutional activity. That's not organic appreciation. That's price inflation driven by capital concentration. For renters, the data is worse. Institutional landlords raise rents faster than the national average in every market they enter. Tenant advocacy organizations across Atlanta, Phoenix, and Charlotte documented a consistent pattern. Fees for everything: pets, parking, trash, late payment, and lease renewal. Aggressive eviction timelines that outpace local courts. Delayed maintenance, and renewal terms specifically designed to make moving out more expensive than staying in. Research consistently shows that in markets with the highest institutional ownership concentration, first-time buyer purchase rates decline measurably, priced out by all-cash competition that conventional financing simply cannot match. The math isn't complicated. When billions of dollars are competing for the same houses that entry-level buyers want, entry-level buyers lose. Washington noticed, and eventually, so did the White House. Then came January 20th, 2026, Inauguration Day. President Trump signed an executive order directing federal agencies to withdraw government-backed financing and insurance from institutional investor home purchases. No federal backing, no GSE loans, no FHA, no Fannie and Freddie. The financial infrastructure that made the model possible at scale, gone. But the order does not ban institutional buyers outright. It does not force them to sell a single property. The 550,000 homes they already own, they keep every one. That order has since been fleshed out into the 21st Century Road to Housing Act, passed by the Senate. Any investor owning more than 350 homes is banned from buying more, and the build-to-rent provision hits hardest. Institutional investors can still build and rent, but will be forced to sell after 7 years. Industry executives are calling it uninvestable. Shares in Invitation Homes and American Homes for Rent have dropped 30% below the actual value of their properties. Wall Street is pricing in the risk. Whether the bill survives the House is still being decided. Here's what this means for your strategy right now. 2 things. Number 1, track where institutional money moves next. Invitation Homes and First Key Homes publish quarterly earnings and investor presentations. They telegraph target markets months in advance. New acquisition activity in a metro means rental demand growth and price pressure. That is your signal. Number 2, watch institutional buying volume in Q2 and Q3 of 2026. If it slows in Atlanta, Phoenix, Charlotte, that is early evidence of supply returning. That window will not stay open long. Wall Street didn't break the rules. They identified a gap, a housing market that had never been institutionalized at scale, and moved billions into it before anyone understood what was happening. Single-family rentals are now a $4 trillion asset class. The firms that built it are publicly traded, highly capitalized, and politically connected. One executive order will not unwind what took 15 years to build. The competition is permanent, and the price pressure is structural. Follow and subscribe to The Loan Insider.